Hey guys, welcome back to the Joyful Investors channel. In today's video, I would like to touch on this one big mistake that many investors have been making that is causing them to lose money. Before I go on, if you would like to receive more investing content to help you become a better investor, go ahead and hit the subscribe button. So here it is. The biggest mistake that I see many investors making is that they ditch their portfolio or some of their holdings when those investments don't seem to be making money within a certain short time frame. As I scrolled through the investing forums and groups on various sites, occasionally I noticed that there are a number of people asking about whether they should be closing off their positions and shifting the funds to other holdings because of reasons such as portfolio drawdowns or portfolio earning bigger returns of just a few percent. During the China tech massive sell-off, there were many investors contemplating about selling their stocks, and there were many others who actually sold off their stocks at a very low price. Then there are also some whose current robo-advisor portfolios are not doing that well, and they are concerned about whether they should be shifting the funds to another robo-advisor. And once you do that, you are losing money or could be losing even more money than you thought. Because firstly, those temporary paper losses that you have are going to crystallize into real losses. Secondly, you are incurring the opportunity cost for giving up the potential gains in the future. The worst is to see the prices rallying back up shortly after you sold off those positions or those investments that you thought are not going to make you money. Well, all this only points to one thing. You do not understand the markets well enough, and you do not have conviction or even a clear understanding of what you are invested in. And you think investing is a means to get rich quick. The stock markets move in cycles. Yes, no doubt, some stock markets, like the US stock markets, move up over the long term. But it doesn't move up linearly. In between, the prices actually moves in a cycle. After periods of strong price rally comes periods where the rally gets weaker and prices decline before they go back up on the rally again. Which means you are definitely, or I can even say 100%, going to be experiencing dips, corrections, drawdowns, crashes along your investing journey if you are in it for the long term. Therefore, before we even begin investing, we need to have the right mindset that we will be seeing negative numbers or the red numbers in our portfolio at some point in time in our investing journey. You may ask, what should we do then? I don't want to be making losses. Well, short-term price stock performance should never be used as the sole gauge as to whether or not an investment is a good one. Because the stock market can be pretty irrational in the short term. So anything could possibly happen to the stock prices. The key lies in whether we are making a good investment or buying a good company for the investment. This involves having the knowledge to understand the business of the company to develop a strong conviction in the stock or in the investment. When we do not understand what we are investing in, it is very easy to give in to our emotions like fear and panic when we see the prices are declining. For example, companies like Alibaba and even MasterCard have been losing favor among some investors because their stock prices have not been performing for this year, 2021. So there are many investors who actually said that Alibaba stock is just trash. And some are also asking, why is it that MasterCard stock prices are not going up? We should instead be focusing on the fundamentals of those companies and not the stock performance in the short term. Over the long term, these companies with solid fundamentals are going to be performing well. And the moment you give in to the panic selling, you have already lost the battle. In fact, even though MasterCard's year-to-date returns for 2021 are almost flat, It is actually one of our top few performing holdings in our portfolio as we have employed our Moneyball stock investing strategies and with options play. This is why we have been emphasizing that we need to have a bag of strategies in mind so that we know what to do under different market conditions. And as for Alibaba, we are still holding on to the stock as covered in the videos that we shared about the China markets. You can check them out if you haven't yet. The same goes for the investments made with the robo-advisors. While robo-advisors are a convenient option for investors these days, we should still do ourselves a favor by learning some essential knowledge of the markets and the various investment instruments. Because after all, the portfolios that robo-advisors build are made up of the same type of underlying investment instruments that we have in the markets. Ideally, you should have a sense of how investing works so that when you face drawdowns in your robo portfolio, you can still make educated judgment of what to do next. Do not assume that investing is the easy way to get rich fast. This is the most dangerous mindset to have. Give your investment some time for it to grow. Unless the fundamentals have worsened or the investment is a bad one to begin with, then yes, you should be trimming off the positions or to cut your losses altogether. Thank you for watching and do hit the like and subscribe button so that you can be in the loop for more videos to come. Do also check out my other video on the 7 common investing mistakes you must avoid to learn more about other common mistakes that investors make in their investing journey. See you in the next video.